it was the Monday morning, and I had told him I wish I had not done the slides just yet because the market was starting to go into its full meltdown from the DeepSeek news. But I think we're starting to see today that we're maybe moving back to a little, maybe back to reflecting on the news and figuring out where we go from here. So the taking a breath was probably a good idea. So let's jump into today's presentation. This was U.S. exceptionalism was part of the topic at the event, and there are a lot of views on it. I'll go through that and talk about the S&P, where we are today, and where I see opportunities. So it is a whole new world, and there are a lot of risks and opportunities. On the risk side, you definitely have the Trump factor and the herky-jerky nature of policy under the administration, the threats and the unusual nature of that is something we're going to be dealing with for another 4 years. We did see this 4 years ago, although this may be ramped up a level or two because of the experience that he had from the first go-round. I think the other risks are real economic ones around inflation and interest rates and the debts and the deficits that are out there. I think the other risk is that the market expectations prior to yesterday were, I think, pretty aggressive. I think it's not unusual after the run we've had for the last couple of years to have a pullback on news, particularly when there was so much money flowing into the AI area. But I think one of the big risks is the climate impact and how do we pay for it. And I mentioned on the last call, I was out in LA when the fires were starting and were going on 2 weeks ago. And I don't think the news did justice to the damage that's being done there. And I think the challenges will be felt there economically for quite some time. But you also have the rebuild that's going on in the Carolinas from the storms there, and then going around the world. This is not a US problem, it's a global problem. And add to that the rebuild that's going to go on from the conflicts, and when do they end, and how do we deal with that? And what is the damage longer term from all those things are issues we're going to have to deal with. But I think the other risk is, do we get the productivity gains that we need in this environment? So there are plenty of risks out there that we are going to have to deal with, and they'll be with us for some time. But I do think there is a case for continued U.S. exceptionalism, even with the nature of this administration's threats to the rest of the world. And I think it's because of the underlying strengths of the U.S. and that we are poised for continued growth. I think it's the innovation that we have, the productivity opportunities that are right in front of us right now. I think the massive investments we're going to continue to make in infrastructure on all levels of government. And even if DOGE works and we slow down government on the federal level, spending on the federal level of government, the state local government's going to have to pick it up because we have needs that are real. We're in infrastructure. 3 years ago, the American Society of Civil Engineers, who does a report every 4 years on the gap of needs versus the financing gap, said we had a $4 trillion gap then. That's expected to grow because we are underinvesting in those areas. But we have massive demands on the grid. We have massive demands from infrastructure needs. I think the reshoring we're going to touch on a little bit in this presentation is continuing. And a lot of the tariff threats are driving capital to the U.S. so that people can avoid the tariffs. And that keeps business going here. Obviously, AI is top of mind for everyone, but the rebuild I talked about, the climate, national security is an issue that's going to be with us for some time. I think the issues there are growing, and AI is making that more of a problem. You have the subsea cable issues that are going on that are creating other issues with national security as well. And then what AI and what we're learning from wars in Ukraine is the old way of defending your country is not going to be what you're going to be using in the future. And we're going to have to revamp our spending, not just the US, but all countries, to deal with the new wave of technologies for fighting and protecting your system. And then today, the US announced that they're going to look at a US Iron Dome. So there's more in that area more dollars are going to flow there. It may flow to different places than it has in the past. I think that's really the change that's going on that we're going to have to step back and deal with. Is there are going to be new winners and losers. There always are, but this is at an accelerated pace, it feels like. I think spending is going to continue. And the spending that we just talked about is increasing corporate earnings. The distribution of those increases has not been even and should not likely continue to be even. But you are going to see earnings continue to grow in aggregate, cash flow continuing to grow, dividends continuing to rise. Buybacks were $1 trillion last year, and their announcements are continuing. And now there is a need for a more aggressive M&A. And one of the challenges that was delaying that was people were hoping for rates to come back down so they could get better valuations. But I think there's starting to become a realization that rates are going to be a little bit more persistent at these levels, if not range bound, plus or minus 50 or basis points or so from where we are is our view. But the U.S. does have a lot of strengths, and we are driving capital to it. Some of its policy, you could agree it's good or bad. But in the near term, it is having an impact. And you can see it from new greenfield projects announced since 2002. But look at the upward trend in the U.S., really starting from the pandemic and moving forward. But look at the UK and China, for example, going in a different direction. But these are the number of projects. These are the dollars. And you can see from the chart, the dollars are really on the rise in the US and India as well. The UK is seeing a little bit of an uptick. China is still in outflows, and that is a problem that they're going to have to reverse to deal with the economic challenges they have and get to the rebalancing that they need. Where's the dollars going? This chart gives you a pretty good sense of where foreign dollars are coming in for new greenfield projects in the US. I believe a lot of the real estate is around the data centers primarily. And I think you can see the other areas. Interesting in the market moves yesterday, CRM was up several percent. Apple was flat. So when you think about big movers in some of the shifts, software and the ability to deliver technologies, AI was not viewed as having big spend in that area. So they're not viewed as that, but they are the delivering mechanisms for a lot of the artificial intelligence out to the world. So interesting where the spend is going. Industrial equipment, a lot of this is around the rebuilds that we're seeing around the data centers and that move. So I think you'll see that continue, but you also are seeing areas that were highlighted at the conference, like the autos, where you see auto components. People are getting ahead of the tariffs and shifting production facilities to the US in anticipation of tariffs. So while the approach of the US government and the current administration and threatening tariffs is actually having the effect of driving capital to the US in advance of that. I also think that there's been a lot of pre-buying of stuff in advance of tariffs too, which could see some softening in some of those areas to follow. But one of the big questions is, does this continue or not in terms of capital flows? And I think in the current situation that we're in, the interest rate differential between the US and many parts of the developed world people seeking yield will come to the US. In times of great uncertainty, we are a safe haven and continue to be that. There was a lot of discussion around the reserve currency status. I don't see that as a threat in the near term or in the long term right now, in the next 5 years or so. And the reason for that is severalfold. One is it's very difficult for an autocratic nation to be a reserve currency. How do you trust one person to tell you what everything's going to be? So that's one issue. But I do think there is a degradation going on with our policies that are creating swaps and other things that will slowly reduce the dollar's impact if we're not careful. And I think that's one of the issues that was raised in the earlier discussion we're having. And I think Trump has to be careful that he doesn't snatch defeat out of the jaws of victory with some of his policies are actually fundamentally not bad and actually good for the economy. It's the going about it that's really off-putting to a lot of people. But if you do that too much, you actually lose your trust. And when you lose the trust, people find other alternatives. So I do think that's a risk that we go too far. And that's always the risk when you have aggressive foreign policies. On the other hand, people forget how liberal our foreign policies have been and how supportive we've been to the rest of the world. As Europe, they haven't spent on defense because they were riding on the coattails of the US for a long time. So some of this is a rebalancing more than a complete change. and an adjustment to maybe a better, more realistic approach to foreign policy. I think the approach, the tone and the rhetoric is off-putting, but if you strip past that and look at some of the fundamentals, it is in many cases good policy. It's just masked in bad delivery. But switching gears to one of the big questions on people's minds is what happens now with the Magnificent Seven after a day like yesterday and the broadening out of the economy, and do we see the other 493 start to participate? I think one of the comments that a lot of commentators are having, and Ed Yardeni, who's a close friend of ARS, was on CNBC this morning, and he sees this as very positive, the DeepSeek opportunity as giving the other 493 the ability to improve their productivity without the big spend with the big, like the Magnificent Seven are doing. And now I still don't think all the 493 will be able to take advantage of it, but it does give you the opportunity to see a broadening out beyond those seven. And it does give smaller companies the ability to get involved without the big cost. And that does help the economy and help jobs. So I think that is one of the things that we'll see moving forward. But I also believe the degree of broadening will be directly related to the level of the 10-year. And as you can see from the rate moves, we're right around 450 now. This is a moderate hit to PE. This is for our friends at Piper Sandler Macro, Michael Kanowitz, and he does a really good job of kind of framing this. But if you think about where we were coming into the year, there was high expectations for 4 rate cuts after the Fed made their rate cut. And what you're seeing is not that. I saw from NBC today, they're looking at most 2 rate cuts this year. Even on the Fed's numbers going out 26 and beyond, they're looking at 3.9% on the 10-year. And I think that's going to be a struggle for 2 reasons. One is our debts and deficits are too high. And 2 is there's a fundamental strength in the US economy that's real. And if we continue to see that, those things will tend to keep rates higher for longer. And that's one of the issues. And that will strengthen the dollar if the other economies are continuing to see some of the economic challenges that they're having. So while there's a lot of focus on the dollar strength and the US relative strength, I think there's too much emphasis on what's going on in the US and not enough emphasis on the problems of the rest of the world, that it's not that we're doing so great. We've written this before, and I think it was the title of one of our Zooms a couple on the last month was, the US is the best house in a bad neighborhood. It's not a good global neighborhood. So we look good, but it's like jumping over a very small hurdle right now. So I think this is one of the issues that is going to really weigh on the broadening out of the economy. The other big issue is the capital spend plans of the Magnificent Seven, and will they continue? And this is really interesting because in the last week, 2 of them announced increases to their spending plans. And the question is, will they continue to do that or not? And what changes with that? And right now, I'm not sure that these guys are going to pull back. And in the last quarter, in the last quarterly earnings, not the ones starting today, many of the big companies, Microsoft in particular, was very aggressive in talking about their spending, Meta as well. And they see this as a need to continue for a long time, because if you don't start early and invest heavy early, you can't catch up. And that's their view. I think that was upended a little bit by the DeepSeek move yesterday, but I believe these guys will spend until it starts to hurt their stock performance. And then they'll make adjustments similar to what Meta did 2 years ago with their period of efficiency. But keep in mind, the big tech companies have been laying off people as well this year and for a while. So they are focused on their capital spending pretty aggressively and their headcounts, because they can find ways to do more with fewer people as well. So I think that's one of the issues that will be really important to keep an eye on. So how do we see the world today? I think we're benefiting from near-term and secular trends and the problems of other nations. As much as our strength is what we do, I think it is the problems of the other nations that's pushing us forward. I think China and Europe have had some struggles. We are starting to see some more positive returns out of their stock markets because they've been down for a while, and it doesn't take much to move markets that have been under the weather for a while. So I think the German market's having a pretty good year this year. So there is attractive opportunities in those areas. But like the US, it's a subset. It's not going to be the S&P 500 that works. It's going to be, probably something in the 75, 50 to 100 that it broadens out to, not 400. I think you'll see a similar broadening out of opportunities in Europe and China and the rest of the world. But you really have to play it very specifically. I think investors are now trying to figure out the implications of DeepSeek. That'll go on for months, not weeks, and maybe even longer than that. But it is a real announcement, whether they did it at 5 million or used other chips or not. It did give you a sense that you can use old technologies to get better outputs and to lower the cost. And that does give people the ability to compete without having the big spend that the Magnificent Seven were putting out. And I think that's a really interesting dynamic that we're going to have to see play out over the next year or two. The broadening will depend on rates. I think we'll hear from the Fed tomorrow that they're on pause. I think our expectations are and have been rates are going to be higher for longer. That's been a theme I've been on for well over a year. We don't think, and that was really the strength of the U.S. economy and the spend that we've put out over the last several years. The amount of stimulus that we've put into the system, keep in mind, from the pandemic through the start of the war, was 50% of GDP between monetary and fiscal policy for a problem that may have been 6 or 7% GDP loss. So we still have a lot of stimulus that's working through the system. It's starting to slow down. But if we start cutting rates again, you could actually really see an acceleration of inflation, which is stubborn and will be a challenge to get down from the 2.6, 2.7 levels down to the 2% that the Fed's targeting. And I think there's a lot of optimism from a lot of people. When you hear the Fed guys talking about they see a path to getting rates down, some of that is keeping the pressure off Powell and the Fed from the Trump administration, who wants lower rates. But I think Trump will be disappointed on his desire for rates to go down, because I don't see the need or the opportunity to lower them. And if we do get too aggressive, you'll actually trigger inflationary pressures that I think will be problems. I think the other issue that you're having a meeting in Palm Beach from the GOP right now, trying to figure out how they're going to bring the Trump policies to light and to work. And there is a complicating factor, and it's the debt and the deficit levels that are really uncomfortable for a lot of the more conservative elements of the party. And how do they bring them in line is going to be a challenge, because we do have real issues here. And some of the policies, the idea of we'll make them up in tariffs is not tested, and most people believe that's not a reality. You'd have to get it on growth from that, and there is a time issue. I think part of the reason for delaying or talking about phasing in tariffs that Bessett's talking about is he is worried about triggering some shorter term inflationary pressures. But we're in a spot now where this is going to be very complicated, and Congress is going to have to come up with a way to figure out the trade-offs. And I think the Republicans might be boxing themselves in if they're not careful, because they could trigger exactly what they don't want. And in 2 years, we're going to have another midterm election for Congress, and you could see a pretty big flip at that time of the House. So there is a window here that people who are up for election are going to say, can this help me get reelected or not? And how comfortable I am if debt and deficits don't come down and we don't get the growth we're looking for. So we're kind of positive on the U.S. markets right now. I think this pullback that we saw yesterday, we could have another leg down and still be only at a 10% correction level, which is actually not unhealthy, given that we've had a 40% plus move in the last 2 years in the markets. But I think rates and the spend are going to be the big issues and the limiting factors of what can go on. And I think we'll continue to spend here. I think other countries are going to up their spending as the U.S. pulls back, which is going to help Europe and help some of these other areas get back on track better. I think the European problem continues to be, how do they take all the great resources from these individual countries and leverage it into a powerful economic force that they can take advantage of and scale up and win? And I think that's a real challenge because of the lack of leadership around the world that exists today. Because when you have such big problems, they require really clear, good decisions that are collaborative. Because we have a world problem right now. Global debt is at a level that should be really uncomfortable for people. And I'm a little surprised people are not more uncomfortable with that. And I think it's because there's been a lot of hope that rates will come down again as they did with the '08 period. But I think the economy can't afford that. And I think that's the difference between where we were before and where we were now. And I would say that governments wasted a massive opportunity over the last 15 years that actually the big tech companies took advantage of. So while governments should have been putting out 50-year debt at zero interest rates or 1%, they were not doing that. They're doing it now at 4 and 5% interest rates or even higher. But if you look what Apple did, they did 50-year debt a couple of years ago at 1.5%. And that's what they were doing. So they used the capital markets the right way. Governments have wasted a massive opportunity of zero interest rates and are now faced with really uncomfortable trade-offs that they could have been much more, put money to much more productive use at the time. And I think when we look back, that's one of the big mistakes that people will miss on when they focus on the Fed went too long and we put too much stimulus into the system, which I think we did at the wrong time. You can't overstimulate a good growth economy and not have bad outcomes. So I think that's something that I'm fascinated doesn't get more talk. And I think when they look back, they'll say that we lost a massive opportunity to do a lot of good along the way. So Mark, I'll stop there and open it up for discussion and opposing views. Always welcome.
So thoughts, questions? I see Bill and Adam. Bill, go for it.
There we go. Okay, almost owed you a beer. Yeah, I definitely want to emphasize your point on market broadening. It was very interesting. Yesterday, the Dow was up actually 0.6, and the S&P equal weighted was flat. And so far on a month-to-date basis, the S&P cap weight is up 2.2%, which is going to be a great month regardless. But the S&P equal weight is up 3.9. So that's like more than 100 basis points difference between cap weight and equal weight, which is admittedly like it's unprecedented in this market that's been led by the Mag 7 and the large cap components of the S&P.
That was all yesterday, Bill.
Yeah,
that outperformance. Prior to yesterday, the value was lagging pretty considerably, and 4% will do that for you. But I agree, that is something to keep an eye on.
Adam?
Yes, Stephen. In your last slide, you talk about attractive subset investment opportunities, particularly in Europe. You have Europe and China, but what are those subsets in Europe?
They have the same problems we have. They're going to be increase their spending on defense. They have an energy problem that they have to put more money to energy. I also think there is massive infrastructure needs everywhere around the world. McKinsey had a report several years ago saying that we had a $77 trillion problem globally. I'm not sure that was the spend required. I think the spending gap was not insignificant. So the US, I think we have like a $7 trillion problem with a $2.6 trillion gap that continues to grow because we don't make the investments in a timely fashion. So I think those are areas. I also think there will be big opportunities around rebuilds from Ukraine and other issues. But you do have climate damage that's going on that has to be taken care of. So it's all those things that are going on. I also think the whole industrial and military complex is, as you've talked about here forever, is going to be an area that's going to attract capital. I think one of the issues that Europe's still facing is their legacy industries are not the areas that are attracting capital right now. And how do they deal with that? So when there's a lot of talk about the undervaluation of Europe, I look at it and say they're undervalued because they have old economy industries that are losing share. They are not big in tech as on the aggregate, and once their leading areas for a long time was their financial institutions. And since the great financial crisis and the problems in Europe, they didn't recapitalize them the way the US did. So I think they have that weakening of their financial services sector has been one of the anchors. So they have to figure out that as well. And when you're down so long, you can fix those things or find opportunities if you find the right companies that are making the turnaround. I did see that HSBC is actually eliminating out of Europe a lot of their investment banking, M&A, and other industries, not only out of there, but out of the US as well. And I think they're focusing on Asia. And I think that you'll see some of the industries making pivots like that, or companies making pivots like that, that'll give you opportunities to say they're doing something different. And is that going to work? And if you think that's an area, go after it. So I think you'll see those same things, but I think the themes are the ones we talk about. It's energies, industrials, it's defense. National security is going to be much broader than that. And so I think those are the issues. But keep in mind that the tech sector, while there are great tech companies in Europe, the tech sector is tiny. The US, it's huge. So I think that you have to look at these markets. I mean, say one's undervalued and one's overvalued. I think the US is overvalued. I said that in the last couple of weeks, but that doesn't mean that overvaluation can't continue for longer than people shorting it can go broke. But I also think that there are shifts that start to happen and you have to be looking for them. And while I've been very negative on Europe, I do think there are a number of opportunities that are starting. But you're also seeing for us opportunities where companies are looking to move their listings from Europe to the US because the multiple differential. And I'll give an example of one, and I don't know the number where it is right now, even though we own it in our portfolio. Okay. Yeah, and Ken Goldman underscored that as well. But we have a company in our portfolio called CRH. They're an aggregates company that was selling in the UK at like a 12 multiple. MLM, one of their rivals in the US, was selling at about a 24. They relisted to the US, immediate multiple re-rating, and the stock went up. Good business before that, better business now with a better multiple. So I think you'll see things like that going on, Adam, that will give you those opportunities. I'm having trouble seeing hands.
Questions?
Yes. Yes. Yep. Yes, through the speaker, yes.
So, Steve, I had a question, which is the relisting of the companies that you mentioned, right, from Europe to the States. Clearly, there's some arbitrage to be had, right, or some valuation growth to be had. However, the question there is, did they have to, was it the case that most of their business was in Europe as opposed to the US? And as a result, did they have to, let's say, shift their priority of business development or business growth in the US in order to support the US relisting?
Yeah, I think they were benefiting from the opportunities in the US. I don't have their mix off the top of my head. I'd have to check the guy who did the actual work on it. I don't get into our stock research as well. This is a full-time thing for me, but I do think that that's part of what you have to look for in each of those, because just a relisting doesn't help, but a relisting in it, and this was in a theme that we're big on. And when you look at the valuation difference too of the US competitors versus them, it just was that one was a no-brainer for us. So I do think they had a significant portion of their business here already. There are others that are looking at actively relisting though now. So something to keep an eye on.
Any last questions?
Yes, Stephen, it's Anthony Gordon. Hi. I just have a question on, how is it that when a foreign AI vehicle becomes main populous and it's trending on Apple, why is the US government not concerned as they are, such as with a TikTok? Surely it's the most obvious thing is that the AI is learning on itself, and every question and interaction that it's asked from anyone becomes a permanent piece of information. And so surely that gathering more information, call it on US persons, than the likes of a TikTok. So why has there been no response, reaction, and so on and so forth to that?
I don't know the answer to that, Anthony. I think if I had to guess, one, I think Trump is trying to work with China to have a better relation, because if Trump doesn't like more conflicts. He doesn't mind interpersonal conflicts and threats, but I think he views his opportunity to negotiate with Xi as something that he's going to be careful about. He has right now TikTok, where he's trying to work something with them. And I'm not a technologist, but I think the open source nature of this might have a different element. And Apple does have some protections, as I understand it, that help preserve your data over there. Where I think if you use the Google app right now, I understood from CNBC this morning that there's a belief that if you go through the Google using DeepSeek, it can read through your emails and Gmail. If you go put it on Apple, Apple has a restriction that doesn't let you get through your whole system.
Firewall, yeah.
Yeah, so I'm not sure how that, I think that's what it is. I also think it's too new for the government to have a policy yet, particularly with all the administration changes.
Agreed, but clearly, if we're talking about it, they've already thought about this way back, and they're trying to figure out what to do. And this is a global concern. How do you amplify, this rising tide, yet keep security? So it's sort of a, none of us know the answer. We don't understand it. So that yeah, I mean, that's the conundrum. How do you amplify intelligence and productivity, but keep security for sovereign and for their people, if that's a concern, which clearly it is.
Well, I think it is. I think you're on the topic of national security is being redefined. It used to be protect your borders. Now it's protect your people, personal information, and hacking and all that. I think that's a better question for Nick and Hamlet on another call, Mark, because maybe that's a deep dive we would do in a couple of weeks, because we have a little more information on what DeepSeek really means.
Next week is Bill Deichler.
Yep.
And after that, let's talk about tech AI and privacy.
So
Michael Hammer.
I'll jump in and kind of answer your question, Anthony. The big difference is that DeepSeek is open source. And as I had mentioned earlier before the town hall, I have friends who are actually reviewing the code. And so anybody can look at the code, you can modify the code, it's up to you. With TikTok, it's essentially a black box. And that's one of the big differences. So if I download DeepSeek and I'm running it on my own hardware, I can control where the data goes. If I'm using TikTok, I have no idea where the data goes.
Fair enough. Well, let's dive into it. Any last questions? Otherwise, we're gonna adjourn. It's been Thursday night, Friday, Saturday, Sunday, Monday, and here we are Tuesday. I fly home today. I'm gonna recharge our batteries for the next one, which, just to remind everybody, will be February 25th will be the next one. And then New York, there it is, right there. We have a private credit summit as well coming, emerging managers. There'll be an allocator session. Riyadh, the Vegas on the 9th of April. The Palo Alto event on April 24th. A lot more things filling in. We'll do a breakfast during Milken on the 6th of May. We're in San Francisco. We'll be in Berkeley. San Francisco, Berkeley, Palo Alto, Stanford, Seattle. It'll be June 16th and 18th. Newport, July 20, Singapore, and Mumbai. We're combining those. They're back to back in October. Oh, London in September. Just keep on your radars. And we're going to Texas. We're trying to fit in a 3-city tour again. We haven't done that since 2019, actually 20, January 2020. So thank you, everybody. Appreciate your time.
Have a good day.